Well, holy smokes everyone, BlackRock just took a massive hit on one of their big loans. But what if I told you this is just the tip of the iceberg? We are seeing corporate defaults and mortgage-backed security defaults skyrocket past 2008 levels. And guess what people, the signals are absolutely everywhere. In this video, I'm not going to just try to scare you, I'm going to show you all the facts on why things are actually screaming us to say something is very, very wrong. Companies are failing left and right. They took on massive amounts of debt when interest rates were at zero from the Federal Reserve, but now interest rates are skyrocketing and they're failing at unprecedented speed. So people, while everyone's euphoric with the market skyrocketing higher and higher because of all the money printing that's going on right now, they do not want you to know what's happening underneath the surface, what's happening behind the scenes in the financial system. But I'm going to pull back the curtain and show you everything that's happening right now. But I won't just show you all the bad things that are happening. I'll also give the exact playbook on how you can protect your money, your wealth, and your family. Because people, what we're about to see will make 2008 look like child's play. So everyone, without further ado, you know what time it is. Let's get straight into the news, the facts, and the data. Well, okay, everyone, look at this. This is very, very alarming. So 63 US corporate bankruptcies in June set up 2025 for the highest pace since 2010. That's right, everyone. The highest since 2010, and it's actually accelerating towards the end of the year. Because bankruptcies didn't actually peak in 2008, a lot of companies were able to try to extend and pretend. Maybe they tried to prolong their bankruptcies a little bit longer. A company doesn't go from solvent to bankrupt overnight. So we actually saw most bankruptcies in 2009 and 2010 after the global financial crisis. So if we're at levels like that now and we haven't seen a massive institution go bust, that tells us that when this next crash does come, it's going to be far worse. But again, like I was telling you, this is just the tip of the iceberg. This is going to be a deep dive. After this, I'll show you what just happened at BlackRock, but what's happening across mega institutions all around the world. So I'll go ahead and bring up this chart here, and we can see the blue, this is defaults year to date. And as we can see, we haven't seen this blue line here at this level since 2010, and the trend is rising and rising rapidly. Now let's go ahead and break it down by industry. So we can see industrials is the top at 58. Then we can see consumer discretionary, healthcare, and consumer staples. So people, are you starting to get the picture here? Things are not okay. Things have never really recovered since 2008. They just printed and covered up all the problems with more money. But okay, what you're really wanting to know, what happened at BlackRock and what is this going to mean for the markets going ahead? Well, look at this everyone. BlackRock faces 100% loss on private loan, adding to credit market pain. Now, some people have done videos on this already, but I'm going to go much, much deeper than other people have gone on what's really happening on the macro scale. But a lot of people just read this article and said, look, well, this loan's only $150 million. It's just peanuts for BlackRock. And while yes, that's true, we have to look for the warning signs because it doesn't go from everything's fine to all of a sudden BlackRock or Goldman Sachs or, like 2008 Lehman Brothers collapses overnight. There's many events that happen leading up to that collapse that try to warn us that something is wrong. But unfortunately, many people like this story that happened in BlackRock today will just go, oh, well, that's just a small institution, nothing really to worry about. Well, wait until you read this. Well, about a month ago, BlackRock Inc. deemed the private debt it had extended to Renova Home Partners, a struggling home improvement company, to be worth 100 cents on the dollar. As of last week, the firm has had a new assessment and it's now zero. So did you hear that, people? Just last month, these were going for 100 cents on the dollar, and they're now completely collapsed. They're completely worthless in just a month. And people, I believe this is just the first domino to fall. And we're going to see much more corporations like this go down because of the next story, which I'm about to show you in a moment. But first, let's finish this one. So the drastic revisions come as Dallas-based Renova, a roll-up of regional kitchen and bathroom remodeling business created by private equity firm Audax Group in 2022, abruptly filed for bankruptcy last week, indicating it plans to shut down. It was no mystery Renova was in a tough spot. In April, lenders had agreed to take losses and convert some of their loans into equity as part of a recapitalization that was supposed to give the company a chance to turn its business around, the people said. In the third quarter, they also allowed for deferred cash interest payments on its restructured debt, an arrangement known as a payment in kind, regulatory filings show. So this is what a lot of corporations are doing right now. They're just simply extending and pretending. There is a record amount of zombie corporations right now. That's companies that simply can't even afford to service not their principal and interest, just their interest payments. And if the Federal Reserve doesn't drop interest rates quick, we're going to see an absolute avalanche of defaults. But again, even Bloomberg is admitting this is a signal that the credit markets are facing severe pain. So while Renova debts represent a slither of total assets for three lenders, its sudden collapse strikes at the heart of what critics see as major vulnerabilities in the private credit market. The disconnect between the valuation of illiquid loans and the performance on underlying companies. Zip's car wash similarly enjoyed marks that were near par from its private credit lenders months before filing for bankruptcy earlier this year. It also comes in the wake of collapse of subprime auto lender Tricolor Holdings and car parts manufacturer First Brands Group, which have caught investors off guard. They stoked fears there could be more pain to come in credit markets and led Wall Street executives to trade shots as to who is to blame for poor underwriting standards. Well, it's very, very simple, everyone. When the Federal Reserve goes ahead and drops interest rates to zero, or many other central banks around the world do this and say, come on guys, take on as much debt as you want. We won't lift interest rates. Go ahead and do it. Well, that's going to cause people to speculate, and now the speculators are getting punished and punished big. But again, this is where many people that were reporting this story simply stopped, but I dug deeper and deeper to figure out what's really happening in the financial system, and people, you're going to be shocked with what I found. So look at this, everyone. Commercial mortgage delinquencies are not as bad as 2008, now surpass, not around 2008, the financial crisis peak, the very peak. It is far, far worse, and you need to start paying attention right now, people. And this is what I've been trying to warn people about on the channel right now, and things are starting to materialize. So in November 2024, US commercial mortgage delinquencies spiked to 10.4%, a level just below the 10.7% peak during 2008 financial crisis. And commercial real estate CRE delinquencies surged again in August 2025, with office and multifamily loans at the center of the slide despite widespread use of extend and pretend and forbearance tactics designed to stave off losses. So this is exactly right, everyone. This is why I've been warning about, this could be something coming, but we haven't seen it yet, because there's been a lot of tools, a lot of tricks these big commercial real estate companies have been able to use to extend and delay the crisis, but now they simply can't kick the can down the road. The road has ended. So according to TREP, the delinquency rate of office mortgages packaged into commercial mortgage-backed securities, that's CMBS, jumped to 11.7%, surpassing the financial crisis peak of 10.7%. That is insane, everyone. As of recently as December 2022, the rate stood at only 1.6%. So that's absolutely insane. You're seeing how bad things are getting. It was 1.6% in 2022, and now it's 11.7%. This is highlighting how quickly stress has spread. Multifamily commercial mortgage-backed securities delinquencies rates also spiked, reaching 6.9%, their highest since 2015, and 2 years ago, the figure was just 1.8%. So people, you better buckle up, start really paying attention, start warning your family, sharing this video, because I think something's just about to pop. The sharp deterioration reflects rising vacancies, elevated borrowing costs, and weak demand. Newer high-quality office buildings continue to lure tenants away from older towers, leaving the latter with mounting vacancies and unsustainable debt. Multifamily, once considered among the safest CRE classes, has been dragged down by a mix of aggressive construction, financing costs, and slower renting growth. So that's exactly right, everyone. It's not just offices that are struggling, it's also multi-family homes, because rents have got to such levels that people simply can't afford to pay them. And that's why we're seeing a homelessness crisis at the moment. So this is now checkmate for a lot of these large real estate firms. They're about to take big losses, and now with interest rates much higher, we're going to see defaults continue to rise. And I'll go ahead and bring up this chart here, people. Look at this. This is a very, very alarming trend. We can see here, late 2022, then early 2023, it absolutely just took off like a rocket. So one example is a 1.04 billion mortgage on 1211 Avenue of Americas, a 2 million square foot Midtown Manhattan tower. The 1973 property became delinquent in August when its balloon payment was missed. Yet a 3-year extension pushing maturity to 2028 means a loan will soon come off TREP's delinquency list. So again, they're going to try more and more tricks to delay the inevitable, but the inevitable will come. Multifamily loans, however, represent a much larger share of commercial real estate debt, about 2.2 trillion or 45% of the 4.8 trillion total. Roughly half of this debt is backed by government-sponsored entities, Fannie Mae and Freddie Mac, whose share of multifamily exposure has doubled in the past decade. Banks and thrifts hold 29%, life insurers 12%, and private commercial mortgage-backed securities and related securities just 3%. So people, we cannot let the government bail out these institutions again. We need to let these institutions learn a lesson. You can't just take on as much risk as you want, get all the benefits from taking crazy risk when the markets are booming like they are now, but then when things go bad, go ahead and cry to the government for a bailout. We can't do that. I can't do that. You can't do that. And if we keep on going down this road, the dollar will become worthless and your taxes will skyrocket. There's no free lunch, people. But now this last report is definitely the one you need to pay attention to. So look at this, everyone. Big brands are crashing. US corporate bankruptcies soar. So it says here, easy money during the pandemic years helped many companies survive, but it also led to dangerous borrowing habits. For years, US corporations enjoyed ultra-low interest rates that made borrowing money feel practically risk-free. This encouraged businesses, both big and small, to pile on debt, often to fuel expansion, buy back stock, or simply stay afloat. But once the Federal Reserve began raising interest rates in 2022 and 2023 to fight inflation, those cheap loans became expensive liabilities. Now in 2025, companies are feeling the full weight of their debt obligations, especially as consumer spending softens and revenue slows. That's exactly right, everyone. They got very, very cheap debt during COVID. Now interest rates are much higher, and all these companies that look like geniuses, well, what does Warren Buffett say? It's not until the tide goes out you see who's been swimming with no pants on. Because some companies mistook debt for success, expanding too fast or acquiring too many assets without having the long-term cash flow to sustain them. In a low-rate environment, this strategy worked, but in today's tighter credit market, it's a death sentence. And this has led to the rise of private credit and shadow lending, but this will also lead to the collapse. As traditional banks pull back from corporate lending, non-bank lenders and private credit firms are stepping in. While they offer lifelines to some companies, they also come with higher costs and less transparency, and this could lead to more surprises in the near future. So that's right, if a lot of these companies are getting shadow loans and they're not telling their investors or not reporting this in regulatory filings, well, we may find a company default on one of these shadow loans that they haven't told anyone about, and we could see some kind of financial event happen overnight. So I know what you're thinking, well, okay, what does this mean, and what are some scenarios that we're facing? Well, there's 3 scenarios here, everyone. Scenario 1, soft landing with fewer bankruptcies. So if the Fed successfully engineers a soft landing, credit conditions could ease and only the weakest companies will fail. Well, I think this is very unlikely because we're already seeing layoffs skyrocket. Scenario 2, recession-driven wave. A US recession would send even more companies into bankruptcies, potentially breaking records set in 2009. And I think this is a much more likely scenario based on all the evidence I just showed you. And the worst case? Well, sector-specific collapse. Even without a full recession, certain industries like commercial real estate or retail may continue to suffer disproportionately. So everyone, I hope you can finally see, I hope your eyes have been opened to the real crisis that is happening. I've shown you with the news, with the facts, with the data that it is happening and things are getting far worse. So time is running out. You need to prepare yourself, your family and friends right now. So what can you do to prepare yourself? Well, it's very, very simple. You don't want to be like one of these corporations taking on massive amounts of debt. So you want to pay off all your high interest rate debt. So if there is some kind of credit crisis and the banks start calling in these loans, you won't have to stress. Then once you've done that, don't even think about investing yet. You want to go ahead and start building an emergency fund. Now, it's unfortunate that many people don't have the discretionary income or any income left over, so you're going to have to do it the hard way. You're going to have to either work overtime, get a second job, or what I think is even better is start a side hustle business that could eventually replace your real income from your job, because I don't think jobs are safe anymore, and you don't want to have to rely on a boss to get a pay rise when inflation is at 5 or 10%. Real inflation, that is. You want to be in control of increasing your income. So then once you've done that, you've paid off your high interest rate debt, you got your 3 to 6 month emergency fund, then you can start investing. We're seeing gold blast past $4,100 an ounce. I think these big institutions know that the dollar's days are going to end. Fiat currencies around the world are becoming worthless, and we're going to see some huge financial crisis, and those that own the gold will own the real wealth. Me also, another way to diversify out of the banking system and to hedge against inflation is Bitcoin, but that's a very small part of my portfolio, only 5 to 10%. If you do this, you will not have to worry about everything. When everyone's panicking, when everyone's in debt, when everyone's got no emergency fund, you'll be okay, and you'll be able to buy assets for pennies on the dollar. But everyone, what do you think what happened with BlackRock? What do you think about these corporate defaults? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.